Hey, welcome to this video on probably one of the easiest option trading strategy for beginners. And we're going to dive into the concept of covered calls. And we're going to explore why they're a pretty great choice for those that are just starting out. First, what are they? Covered call is just a strategy that involves selling a call option on securities you already own. So this allows you to generate income from the premium that you receive while partially shielding yourself from potential price drops in the stock. Now, it's important that you know that if the stock that you're holding in that price and it climbs above the call strike price, you could be obligated to sell your securities if the buyer of the call exercises their options. So that's where things can get a little bit tricky, but don't worry, we're going to cover that too. So when that stock price climbs above the strike price, we call it in the money. So this means that this call option has value called intrinsic value. Now, these in-the-money calls, they offer higher premiums, but they also come with a higher risk. So the key is that you got to find a balance between risk and potential reward. Now, there are other key strategies that you might come across, like selling puts, long call, long puts, vertical spreads. Each of these has their own unique risk management characteristics that you got to understand. So, for example, selling puts is like betting the stock is going to rise or stay flat, but it comes with risk if that stock drops. On the other side of that, a long call has potentially unlimited profits if that stock soars, but you got to understand intrinsic value to calculate potential gains, and that's a lot to consider. So how do you implement covered calls? Remember, you do need to own at least 100 shares of a stock. Once you own them, you can sell an option on that stock. You're essentially offering someone the right to buy that stock that you have at a certain price within a specific time period. So this is going to help you earn income from the premium received from the sale. But remember, if that stock price goes up, you may have to sell your shares at the strike price to whoever bought that option. Now, it's a pretty simple strategy, but you got to consider the potential outcomes before you do. So the pros and cons, pretty simple. They're easy to implement. They do provide a regular income. They do come with limited profit potential, and that is whatever you received in premium. And there is substantial downside risk, but you got to understand the strengths and the weakness, and that's going to help you navigate trading in this kind of way. So to keep it nice and clean here, covered calls, probably one of the simplest option strategies out there. It's going to offer you some stability, some income. When you understand that concept, which is selling the call options on stocks you own, that you can provide yourself with a regular income, and you could mitigate potential losses on that stock to some extent if stock prices are falling. Now, there's other option strategies that you can explore. They all have their own risk management characteristics, and you really got to understand these strategies before you dive into them. So this is a pretty simple foundation about covered calls. And any other options trading strategies out there, we got tons of videos here on our YouTube channel. You got to find the best strategy for you and understand the risks, the benefits. And again, everyone's got their own situation. If you want to reach out to support@netpicks.com for any options trading information, hopefully we can answer any of your questions and help you out on the road to successful options trading.